and then some loan programs that can help them navigate those struggles.
Awesome. Yeah, we're looking forward to this. So go ahead, Chris, and dive right on in.
All righty. I'll talk a little bit about entity structure and it kicks off. So first question is, what is entity structure? I'll go to the next slide there, Jared. So what is entity structure? Entity structure is a government classification that is used to determine your tax burden as well as your liability. So when it comes time to pick your entity structure, you really want to think about it holistically. What are the tax implications that are going to be attributable to the entity that you end up selecting, as well as what are your liability considerations? If someone sues you, what is that going to look like? Another thing you need to look into is the amount of administrative work that comes along with it. So the amount of headache. Like I tell my clients, that's your return on hassle. How much of a pain in the butt is it going to be to operate under a certain entity structure? And then if you are a person that is needing to raise capital, for a real estate venture or as a business owner, different entity structures have different considerations when it comes to raising capital as well. We'll go to the next slide here, Jared. So what are the options that are available to you? So if you are a single owner, you have 4 options available to you. You could be a sole proprietor. You can be a single member limited liability company, otherwise known as a single member LLC. Or you can be an S corporation or a C corporation. If you have multiple owners, you also have 4 opportunities or 4 options available to you. One, you could be a multi-member LLC. You can be a partnership, or you could be an S corporation or C corporation. So now we'll dive into the definitions of each of these entity types and some of the advantages and disadvantages that come with each one. So we'll get sole proprietor out of the way. Sole proprietor is the simplest one. So if I just start doing business today, and I have not registered anything, I've not filed anything, and I'm doing it all myself, by default, I'm going to be a sole proprietor. So there's no setup required, and there's also no separate entity. So if someone were to sue, let's say I make widgets and sell them online, and one of those widgets happen to, I don't know, someone chokes on it or gets hurt by it or something like that, and decides they want to sue you or sue your business. When they sue your business, they're also suing you. So there's no separation there. There's also no separation from a tax view. So you're going to file everything regarding your business income and expenses all in your personal tax return under sole proprietorship. Generally, I tell people it's not a great option unless maybe you're just getting started and you want to make sure that you're actually going to be able to make money before you worry too much about filing an LLC. But it's usually one you're going to grow out of pretty quickly, just because there's no real tax advantages to doing it. There's no liability protection at all, which is really the biggest thing, I think, in my mind. And then should you be in a situation where you want to raise capital, it's very difficult to do so under a sole proprietorship. Next option, and is definitely the most common option, is going to be a limited liability company. So limited liability company has the advantage of having both aspects of a corporation and aspects of a partnership. So you get these limited liability protections that you would get under a corporation, but you still have the flexibility that comes along with being a partnership. There is no tax at the entity level. So you're not going to have any double taxation just by being in a limited liability company. Actually, this is a very common thing that I see people, especially people in real estate, get confused by. Is people will come to me all the time and say, "Hey, Chris, I want to set up an LLC so that I can save on taxes." Setting up an LLC doesn't in itself do anything to save you on taxes. The biggest reason you would set up a limited liability company in the beginning is to protect yourself from liability, right? That's why it's named the way it is. You'll actually report, let's say you have a a rental property that you own, you'll report it on your taxes the same way if it's in a limited liability company or if you just have it in your personal name and it's not in the LLC. You do have the option of how you want to be taxed under LLC, which again brings a lot of that great flexibility and why this is one of the most common options for entrepreneurs. So by default, it's going to be disregarded, which just as I gave in that prior example of the property you own in the LLC, it's going to show up in your tax return the exact same way. It's basically the exact same as if you were a sole proprietor from a tax standpoint, but you still have that limited liability protection. Next one would be a partnership. So that's going to be the default if you have more than one owner. In that circumstance, you would have to file a separate tax return. So there would be Form 1065 as a separate tax return that is filed for partnerships. And then each of the partners gets what's called a Form K1, which shows their allocation of the income and expenses from that partnership that they will then report on their 1040. We'll talk a little more about partnerships later. You can also become an S corporation. In order to do that, you would file Form 2553, and that allows you to make S corp election. We'll talk about some of the tax benefits that may be attributable to you if you were to go down that route. And then C corporation, you would make that election by filing Form 8832. So you have lots of different options with that LLC. So it's really a great option when you're starting out of the gate to get into setting up your company that way. The next slide here. So let's go into some more of the advantages and disadvantages. So as I mentioned earlier, we have that limited liability protection, a lot of flexibility in the way that you're going to be taxed. So you have the option to choose a different entity structuring that you want to be taxed under. You can also have an unlimited number of members. So you can have, 1,000 people that are members of an LLC. So that's a great advantage if you're going to be raising capital or something like that. That can be a positive for you. Any individual or entity type can be a member. So we're going to talk later about like S corporation, where there's actually some restrictions on who can be a member and the number of members that you can have. With an LLC, that's not the case. There's also relatively low levels of administrative work. So the filings that you have to do every year, and the cost of those filings and the cost to keep your taxes up in order. With just an LLC, they're relatively low, and the headache is relatively low there. You also have the options for some member confidentiality, so you don't necessarily need to put, depending on what state you're in, you may not need to put your name on the articles of organization, which can give you some anonymity. That's one of the reasons that Wyoming is a pretty popular state for people to set up their LLCs these days. So some disadvantages. It's governed by the state statute, right? So you are subject to some of the regulations from the government. You have to file forms every year. So that is a downside. You do have some limits in your ability to raise capital. So oftentimes, and I'm sure Jared could talk to this even more, but like if you're trying to get a loan for a rental property, oftentimes you're still going to have to personally guarantee that loan or put that loan in your name for the real estate, or for a business loan, same thing. It's a lot harder to get business credit. Now, it's not impossible, but it is a little bit harder. And then raising equity, like you can't go, an LLC can't go public and sell stock. And annual fees and taxes. We talked about that a little bit. Next one would be partnerships. So partnerships are going to have two or more owners. They could be anything. They could be an individual owners. Partnerships can own partnerships. Corporations can be partners in partnerships. It is going to be a separate legal entity. So you're going to file that separate tax return that we talked about earlier, that 1065, but you're not going to pay tax at the entity level. So all of the tax will be paid by the partners individually. The partnership return will just report what each partner made from the partnership. So some of the advantages of doing a partnership. One, you have some greater sources of capital, right? So you have more people. Obviously, there's more money that's going to be able to be raised from having multiple people bring money to the table. You're also going to have more brains in the room, which can give you the advantage of having a greater backlog of skill and resources to run your business going forward. Usually there's still pretty low levels of administrative costs here. You do have the difficulty of, well, now you have more people to deal with, which can raise that somewhat. However, it's still relatively low at this stage. There's no restrictions on who can be a partner. So you can have, like I said earlier, individuals, corporations, other partnerships can all be partners. And then you don't have that double taxation like you would with a C Corp, like we'll talk about later. Some disadvantages. So you do have tax year limitations. There's rules on what your tax year could be. It's generally going to be the calendar year, the same as the partners. With like a C corporation, you sometimes will have some flexibility if you want to choose like a fiscal year calendar, if there's some reason why that would be advantageous to you. There's no tax-free fringe benefits in a partnership. The general partners of the partnerships are generally going to be subject to self-employment taxes. We'll talk about later with S corporations. There's ways to avoid that. With a partnership, you're generally going to be subject to those. There's going to be self-employment taxes on guaranteed payments to the partner. So if your operating agreement has guaranteed payments, there's generally going to be self-employment taxes associated with those. Your pass-through losses are all going to be deductible on your personal return with limitations. So if you're, if they're passive in the partnership, there's going to be rules about being able to deduct those losses. And then if you're under a general partnership and you're not an LLC that's acting as a partnership, then you're not going to have that limited liability protection. All right, let's jump into S corporations. So S corporations, again, we're a separate legal entity. So with an S corporation, you will be filing a separate tax return. It's going to be an 1120S is what you'll end up filing. But you're not going to pay tax at the entity level. The members or the shareholders of the S corporation will all get a K1 at the end of the year after the 1120S has been filed, and it will show those shareholders allocation of the income and expenses from the entity and how they should then report it on their personal taxes and pay accordingly from there on their personal return. You can have between 1 and 100 shareholders in an S corporation. And then there's limits on who can actually be a shareholder. Like you can't have a corporation that is a shareholder of an S corp. Let's talk a little bit about some of the more in depth on some of the advantages and disadvantages of S corporations. So again, advantages: no double taxation. Your pass-through income is not subject to self-employment tax. So this is a big one. This is one of the biggest reasons people reach out thinking that an S corporation might be a good move for them. So let's give the example of, let's say you're making $150,000 a year and you're just a normal LLC and you haven't made an S corp election or anything like that. You're going to pay self-employment taxes on that entire amount, which self-employment taxes are generally going to be 15.3% until you start reaching some limitations. However, if you make S corp election, and let's say your reasonable salary would be, let's call it $80,000 as your reasonable compensation, then you would still pay self-employment taxes on the $80,000 as you earn that income. However, the additional $70,000 that is pass-through income from the S corporation would not be subject to self-employment taxes. So it can save you a substantial amount of money there. You also are eligible for the QBI deduction, so the qualified business income deduction. And there's ways to optimize around that where we won't get too much into the weeds here, but the QBI deduction essentially allows you to deduct up to 20% of your self-employment income. And it's limited by the amount you pay yourself in wages, or the amount you pay in wages as a company in total. So sometimes there's ways you can optimize by paying yourself a little bit more on a salary, so that you can then optimize and get a greater QBI deduction. It can be a really powerful strategy for the right business owner. So distributions are going to be tax-free to the extent of your basis. So if you invest $100,000 into the S corporation, and then if the company doesn't make any money, doesn't have any losses, and you distribute $100,000, taking that money back out is not going to be taxed. S corporations are also not subject to the gross receipts test for using the cash method of accounting, which is just a fancy way of saying your bookkeeping is going to be a little bit easier, should you want it to be. And you don't have to go accrual basis accounting if you don't want to. Some of the disadvantages, so shareholder limits. So there's limits on who can be a shareholder. I would talk about that. But corporations can't be a shareholder. You can also limit it to 100 shareholders. So it's not like an LLC where you can have an unlimited number. Generally, you're going to have to be on a calendar year. So again, you're usually not going to be able to pick a fiscal year with an S corporation. There are times where your pass-through tax rate, like the tax rate you're paying in total on your personal return, could be higher than the corporate tax rate. We'll talk about that in a second. With C corporations, pay tax at the entity level, which sometimes that will end up being lower than it would be in an S corporation, where you're just passing that income onto your personal return. Fringe benefits are taxable. Administrative costs start to get a little bit higher with an S corporation. Your tax return can be a little more expensive to do. There's a little more compliance work you have to do throughout the year to make sure you're maintaining an S corporation. You're not losing that status by doing something that's out of line. You do have to pay yourself that reasonable compensation. So you can't just pay yourself $0 and then save self-employment taxes on everything. And then finally, distributions of property are considered sold at fair market value. So this is one of the reasons why it's really a bad idea to keep real estate in an S corporation. Because if you take that real estate out of that corporation, even if you don't actually sell it, then it's going to be considered sold at fair market value. You are going to pay tax at that time. There's a few other reasons you don't want to keep real estate in an S corporation. So just in general, don't do that at all. But that is one of the big ones.
Yeah, that sounds like that could be very costly, huh?
Yeah, definitely. Yeah, and really one of the biggest reasons, like I said, that people do S corporations in the first place is to save on self-employment taxes. But rental real estate isn't subject to self-employment taxes anyway. So the one real reason that you would be doing it and the real benefit doesn't apply. And then there's a whole bunch of downsides on top of that. So definitely never keep real estate in an S corp. Okay, C corporation. C corporation, you have liability protection, just like you would with an LLC or an S corporation. They do pay their own tax, so it's not a pass-through, and then it's definitely the most complex entity structure. So we'll get into some of the advantages and disadvantages here. So advantages: raising capital. C corps, one, you can go public with a C corporation if you ever did get that big where it made sense to do that. Oftentimes too, like if you're raising like venture capital or something like that, C corps like look good for doing that. So it could be a little bit easier to do that with a C corporation. You also have unlimited life. So go back to the example of a sole proprietor. If I get hit by a bus and I'm a sole proprietor, the company dies with me. If I'm the owner of a C corporation and I get hit by a bus, the C corporation still exists, even without me. There's no restrictions on ownership type, so anyone can be an owner. You can have different classes of stock. So you can have preferred stock, common stock, which can give you some advantages when it comes to bringing on investors and things. Should you need to go down that route, you can have a calendar or fiscal year, so you have flexibility on what you want your year end to be. if that is applicable to you, and you do get tax-free fringe benefits. There are a whole list of disadvantages though for a C corporation. One, you have double taxation. So you're going to be taxed at the entity level with the C corporation. And then when you take dividends from that C corp, you're again going to be taxed. There's no long-term capital gains rate. So if you're in real estate and you sell property, you probably know that as you held it long enough, it's generally going to be taxed at a preferred capital gains rate for the gain on that property. However, the C corporation just has the one flat rate, so there's no advantageous capital gains rate there. Losses are not passed through to you, so if you have a loss on your C corporation, that's not automatically going to flow through to your personal tax return like it would with the other entity types that we talked about. It is subject to the gross receipts test for the accounting method, so you might have to do accrual accounting for a C corporation, which just adds a little bit of complexity should you meet that test. If you put your family members on payroll, they are going to be subject to FICA taxes. There's definitely the highest administrative costs associated with C corporations. There's lots of compliance. The tax return is the most complicated here. And then a loss on stock sale is generally considered a capital loss. So again, that could be those losses could be suspended into the future. So if you sell your stock in your company and you take a loss of like $100,000, you're not necessarily going to be able to write off that $100,000 all that same year. It could be suspended. And then there's no QBI deduction associated with C corporation.
Okay. Awesome. Before we jump in, does anyone have any questions so far on the type of entities or the structure of those?
I think they're all bored. So.
All right, let's keep rolling.
All right, let's talk about how to stay organized. So you start a new business. And you need to keep your books and records organized, right, for both tax purposes and for being strategic in your business. So a few of the reasons why that's really important is one, reduce stress. This time of year, especially, I started getting calls from people that are like freaking out because they're like, I have no idea how much I'm going to owe in taxes. And sometimes we do the analysis. It's like, hey, you owe tens of thousands of dollars that you should have been setting aside throughout the year that you didn't know about, and now you have to start preparing for that now. Now it's better to do it in December than in April, but it still would be nice to know throughout the year to reduce that stress. Another thing is capturing every deduction. I talk to people all the time when I'm cleaning up their books and I see that they've missed thousands of dollars in deductions simply because their books were a mess. So just making sure you're taking advantage of everything that you're already spending money on. And then you have the opportunity to do more advanced tax strategies if you're organized with your bookkeeping. So me as a tax professional, if you come to me with messy books and you want to do XYZ tax strategy, I'm going to say no, not until we get you organized, because I don't know that you actually qualify until I know that everything is put together well. It's usually less expensive in the long run. So, if you have to pay for a good software to get it done right, if you have to outsource it to someone else to get it done, to have it done right, it's very often the case that the tax savings you're going to get, the decision-making abilities to grow your business that you're going to get are going to pay for themselves many times over. So what are some things you can do? Number one, you have to have a separate business bank account. So if you're currently running your business all through your personal checking, that's a big no-no. We have to get you a separate business bank account, and that separate business bank account is only going to be used for your business. You're not going to run anything personal through that account. It's just for business. That's also really important. I will mention real quick for if you set up like an LLC with you get that limited liability protection. If you are utilizing your business bank account as your personal bank account, then you may end up doing what's called piercing the corporate veil, which means that should you get sued, a judge will come and look at your your accountant and say, hey, you're just using this as your personal ATM. We're going to throw out the limited liability protection that you did. So your LLC will just be useless at that point. Utilize bookkeeping software. So at my firm, all my clients, we put on QuickBooks Online. So that's definitely a preferred option. I think I saw a question on that. There are other options out there. There's like Waze is out there, FreshBooks is out there. But for me, personally, I think QuickBooks is the best option currently on the market.
Is there a reason QuickBooks? It's just the simplicity of it all, or?
Yeah, it's got a good user interface. It's all online. It connects with everything too. So if you need to have an integration with another system, QuickBooks is really good for that. It's really great for sharing info with your accountant and doing everything virtually that way too. Yeah, it is a little more. It's probably one of the more expensive ones for small business owners. But I think personally, for good reason, I do think it's the best option out there. Hiring a bookkeeper is always a great option. Find someone that specializes in doing bookkeeping for your industry, or works a lot with other small business owners or real estate investors. It can be worth their time and their fee many times over. Definitely review your financials monthly. So don't just look at them once at the year end to see how much you're going to owe in taxes. Like, start finding ways to, one, make sure you're accurate on a monthly basis. So ask questions to your bookkeeper if they're giving you stuff monthly, like, why did you do it this way? Why is it a little bit this way? I wasn't expecting that. And then also try and be strategic with that information you're seeing on a monthly basis to try and make your business better and make real-time adjustments throughout the year. Also communicate with your CPA throughout the year or your other tax professional. So I recommend, especially for a small business owner, right? If you just have a W-2 job and you don't have anything else going on, you could probably get away with just doing, your yearly consultation as you get your taxes prepared. But I think if you're an entrepreneur, even if you're really small, I personally meet with all my clients at least quarterly. I think at least every 6 months is a good benchmark to be hitting. I think quarterly is probably even better because that way you're always on top of your quarterly tax estimates at the very least. Keep track of your receipts. There's great receipt management tools that you can use. Even if you don't want to utilize one of the ones that is out there, like through QuickBooks or HubDoc or something like that, just start a Google Drive where you take pictures of your receipts and keep everything organized in that Google Drive. And then, of course, making your quarterly payments. So just to avoid penalties at year end, make sure you're making those quarterly payments. All right, let's talk about a few tax strategies. So before I get too far into those, actually, let's look at the power of tax-free compounding. So why is it so important that we think about finding ways to reduce our tax burden? So on the left there, we're looking at if we doubled our money 1 time or 5 times, 10 times, 15 times, 20 times, and then the effect on how much money, and we're starting with $1, and the effect on how much money we have at the end. Should we have no tax every time we double, or if we're paying 25% in taxes every time we double? So after the math starts off really simple, right? We take $1, we double it, we have $2. If we pay 25% tax, I guess that was rounding up, but that would be $1.75, right? In situation number 2 there. So it's a pretty small difference, right? 14%. However, as we get out to doubling that 5 times, 10 times, 15 times, 20 times, the difference becomes more and more exaggerated. So when we look over our lifetime of if we're investing in real estate or our own business or something like that, if we can find ways to compound our money at a lower tax rate or even tax-free, you can have very substantial differences in the amount of money you're taking home. All right, let's go on to the next one now. Let's get into some tax strategies. So rather than just list out all the tax strategies for you, I thought it'd be more useful to talk about them, giving some examples. So we created this avatar here, Randy the Realtor. So Randy the Realtor is a full-time real estate agent. He works more than 750 hours a year in real estate, and he's willing to self-manage the rental properties he's buying. So a strategy that is available to Randy is what's called real estate professional status. So let's go to the next slide, Jared. So what is real estate professional status? So in order to qualify for real estate professional status, you have to work in a real property trade or business, which there's 11 different real property trades or businesses listed out by the IRS, and we'll go through all of them here. But a real estate agent would be one that would qualify. And there's 3 tests you have to meet, and they're very closely looked at by the IRS. So you want to make sure that you are hitting these for real and not just making it up. You have to have at least 50% of your time in that real property trader business, at least 750 hours in that real property trader business, and then you have to materially participate in that rental property and that rental activity. And in order to, there's also very strict guidelines on what meets material participation. And essentially it's, I won't go through all the exact parameters of it. We can do that another time if you have questions on it. But essentially you can think about there's no property manager. You're the one that's actively doing the management of that property. And so what you could do is if you qualify as a real estate professional, you can create losses that will now offset other non-passive income. So generally, losses from rental real estate are considered passive. So if you have a passive loss of, let's say, $100,000, you'd be able to accelerate depreciation and have this huge loss of 100 grand on paper anyway from your rental real estate. If that's a passive loss, you're not going to be able to use it to offset non-passive income. So non-passive income would be from your W-2 job or your business. However, if you qualify as a real estate professional, then by default those rental activities are going to be considered non-passive as well. So any losses from that rental property that were previously passive are now going to be considered non-passive and be able to offset other non-passive income, such as the income you make as a real estate agent. And the ways that you would create those large losses are, one, you could do a cost segregation study. So someone could come in and say, break down the property into its pieces, and rather than depreciating it over the standard 27.5 or 39 years, you may be able to accelerate the depreciation or use bonus depreciation to write off that property much faster, possibly do like a large percentage of that property, or at least a solid percentage of that property in even year 1. Go to the next one here. Another example, we'll use Danny the dentist. This is Danny. He makes a lot of money a year as a dentist, right? And he's not going to have the opportunity to make that much money doing other things. And quite frankly, he likes his job as a dentist. So something I would tell someone like Danny is, let's find a way to make more tax efficient income outside of your full-time occupation, right? Because by default, there's not going to be, there's things we could do with retirement planning and using our 401ks and stuff to reduce his effective tax rate as a dentist. However, there's not going to be anything quite as powerful as we're talking about with real estate professional status available because he's a full-time dentist. So what he can do instead is start taking his income after he's paid taxes on it and putting it into really tax efficient income sources that will pay him very tax efficiently in the future. So one option would be to invest in a syndication. So let's go to the next slide here, Jared. So let's say you invest $200,000 into a syndication. That syndication then does a cost segregation study, does bonus depreciation, is able to create a paper loss of $250,000 on this investment. That might be a bit high, but we'll just use that for example. And then they do a cash out refinance on the property after they've improved the property in the syndication, and he gets a distribution of 100 grand. Well, there's no taxes on that 100 grand because his initial investment was 200, right? So when you take out debt, that debt isn't going to be taxed. And now because he created this large passive loss through that cost segregation study and using that bonus depreciation, as he gets profits in the future, so let's say in the next year he gets $20,000 in profits, and has that distributed to him, that's going to be offset by the passive loss that he has been carrying forward from the original cost segregation study and bonus depreciation. So again, that's not going to be taxable income for him today. And let's say eventually he does sell out of the syndication, they make a bunch of money. What he can then do is take those profits and go invest in another syndication. And if he's able to create passive losses from that next one, those passive losses can then offset the gains that he had, the passive gains he had from this original syndication. One more example here is single family Sammy. So single family Sammy makes a lot of money, but doesn't qualify for real estate professional status, right? He doesn't work in a real property trade or business, but he is willing to self-manage his rental properties. Unlike Danny the dentist, he actually has the time to self-manage his rental properties and is willing to do that. So there's something called the short-term rental exception that would be available to him to save on taxes. Let's go to the next slide and talk more about that. So we talked before about how rental activities are by default going to be looked at as passive by the IRS, right? So any losses from those passive activities are going to be, you're not going to be able to offset other non-passive source of income. However, if your average rental period is 7 days or less, you can be excluded from the definition of having that be a rental property. And therefore, that activity is now going to be a non-passive as long as you materially participate. So as long as Sammy is managing the property on his own, that activity, and his average rental period is 7 days or less, that activity is now going to be considered non-passive. And if he has any losses from that rental, it can be used to offset his other non-passive income from his, say, W-2 job, or if he owns his own business. And again, cost segregation studies and bonus depreciation are usually pretty integral in creating those paper losses. Okay, I think I covered it. I think I might have taken up most of your time, Jared, but hopefully you still have time to get
No,
through
you're
it.
good. You're good. Well, this is the fun stuff too. And you've talked about all the tax strategies, what are ways to structure that business. Now let's talk about like actually executing on that and how it's done, because from self-employed people, and I don't know if anyone's bought a house being self-employed, but it can be a pain in the butt. So coming up with some innovative solutions, how can it be done, and like identifying where the pain points are for self-employed people is important. So I think there's a question here for you, Chris. Does the real estate professional designation apply to foreign real estate management as well? Is that more of a complicated situation or something that they should speak to their accountant about?
Yeah, definitely something I'd take that offline, talk more about that particular situation.
Okay, Charlie, there should be a website to schedule a call with Chris too, if you want to dive more into that. I'll get into that. But why do people buy real estate? So first one, there's two ways to look at this from a business owner perspective. Owning versus renting. That's always going to be the big thing, is why do people own rather than rent? There's definitely write-offs that Chris already touched on, mortgage interest appreciation. But if you get into the investor space, like you get cash flow, long-term appreciation, and it's just an overall long-term asset to have. So here's a couple of different markets. So this is my market and this is Chris's market in terms of market appreciation over the last, these go up to 63 years, but more recently, you're looking between 3 to 6% in appreciation of just holding the asset, and this is projected out the next 5 years as well. So here are some common issues faced by self-employed borrowers. First one, they run into where they do have a ton of write-offs and try to claim as little income as possible. And that's a pretty normal thing because, Chris, as you know, and you've talked to a ton of business owners, right? They want to keep their tax liability as low as possible. Next thing, when it coming for assets and coming up for a down payment, money tied up in the business. So as many business owners do, they put a lot of money, a lot of initial investment into their business. They may not have the assets available in order to put down a down payment to buy the property. Another thing that I run into quite a bit is people putting business assets on their personal credit, which I can address that. But then the next one and the last one, this is the most common one that I run into, is not having a long enough history as self-employed. So, many people hear that you need 2 years of self-employment. So, like, what's the truth behind this? But in some respect, depending on program, yes, you may need a full 2 years, but really in a conventional mortgage space, you only need 2 years of tax returns. So an example, this is what I ran into for doing a mortgage for a realtor is he started in September of 2021. He didn't really have any income for 2021, but he still filed a Schedule C. And then in 2022, he had a full year of income, filed the Schedule C. So in 2023, that allowed him to buy by having 2 years of tax returns, but not necessarily having 24 months of being self-employed. We'll get into the non-conventional loan programs, but those will require a full 24 months. Does anyone have any questions on that so far? Otherwise, I'm just going to keep rolling here. So here is a very common Schedule C. This is not anyone's actual personal tax return. This is just an example that I found online. So don't get me in trouble, anybody. This isn't real. But this one is a normal Schedule C that I would look at. So you can see here gross receipts of about 99,000, which basically someone's doing sales of 99,000. And you can see all these write-offs here: advertising, car and truck, labor. They do have some depreciation, supplies, everything here. So if you look on line 31, their net profit is $2,100. So if we were looking at this, there are add backs, which I'll get into on the next slide. But if we were to look at this income, we would say their income for 2018 was $2,179. And that would be the income that we could use to qualify. Now, there are add backs to this income to paint a better and more clear picture for self-employed borrowers. So here's just an example of a calculator that we would look at for one for Schedule C and one for an S Corp. And it's pretty easy for me to calculate that, but obviously we want to make sure that we can maximize. So some of the add backs is depletion, depreciation, business use of home, amortization, stuff like that. So these are the type of things that we can do to add back to income, but it only gets us so far and only paints such a clear picture. So here's my advice with anyone. I don't know why I'd end up doing a decent amount of loans for realtors, but one conversation that I had was realtor bought in March of this year. And when we were going through the pre-approvals in 2022, we cautioned that we needed her primary job and her part-time income from real estate to qualify. And in order for us to find out what that number was, she's like, how much do I need to claim on my income in order to qualify with my real estate? And this is where I think is the biggest thing, and a lot of the issues is tax planning is so important. So if you are thinking about buying 1 to 2 years out, you need to have the conversation with your mortgage lender, but also your tax professional, because Chris, as you know, it's harder when you go to try to amend somebody's taxes to try to do it on the back end. I'm sure that's a pain in the ass. There's additional fees for that. And from our side of things, when people amend taxes, we need the original version. There's going to be explanations on why we're asking for what we're asking for. So I urge you, if this is even a conversation of home buying or buying an investment property, I highly suggest scheduling a call with Chris to at least figure out what your tax implications are going to be and what you're going to claim as income. Does anyone have any questions on that so far? Man, making my life easy. All right. So what are some loan programs that many people see for business owners? And these are specific to investors. You can do this for primary residents, but it's not as common. The first one is bank statement loans. So this is one where you're going to need 24 months of being self-employed. And this can be you living in the house. This can be a second home. This can be an investment property. But instead of us looking at those traditional tax returns, figuring out that your income is going to be $2,100 after all the write-offs, what we're going to do is we're going to look at your bank statements over the last 12 to 24 months, as you can see here. And we're going to look at your deposits to calculate your income. So it eliminates the need for tax returns. We're just looking at deposits for either your personal bank account or your business bank account. But with this program specifically, you're going to need to bring more money to the table. So one thing to keep in mind, the next one, this is probably the most common investor program that I see, regardless of self-employed or not. That is a DSCR loan, so debt service coverage ratio loan. So this one, there's no need for income at all. So if you're going to go buy an investment property, what we would do is we're going to look at whatever the projected rent would be on that property, and figure out what your monthly mortgage payment is going to be. Is the rent more than the mortgage? If yes, it's an approvable loan. Obviously, assuming that you have assets, but it is very much with DSCR, they give a lot of flexibility on who's owning it, the type of property, stuff like that. So, and then a 1099 income. So that would just be like someone who does a sales job for a company, but it's all contract work. So here's an example. This is actually a fourplex in the Des Moines area. This is an example that I ran for a client, well, I don't know, a few months ago. So rents on this place are $3,400. The principal and interest, and granted, I think I had some closing costs in here, but one thing to note with some of these programs is the terms are never really like that fantastic, and there's a ton of different features with these programs. So I ran this as a worst case scenario at 11.5%, because with like a DSCR, there may be a prepayment penalty involved with something like this. So structuring the features of the loan correctly is also important for an investor, but really the payment here is just shy of $3,200, rents of $3,400, so it's a cash flowable property. The DSCR is over 1. That's what we're going to look at to make sure that the DSCR, the debt service coverage ratio, is over 1. That way, that would make this an approvable loan, a cash flow opportunity, and then start collecting, those tax write-offs, have a cash flowing property that's appreciating at 3 to 7%. So if you were a primary, looking to buy a primary, this is where we would go to, more like the conventional loan space. If you were looking for like low down payment options, so a conventional loan and FHA loan, these are the two most common types of loans for primary. So going back to my initial, where we were looking at potentially, having your assets tied up into the business, but you still want to buy a primary house. So there are down payment assistance options in each state. Specifically for Iowa, there's one that would cover up to 5% of the purchase price. It is a second loan, which many down payment assistance programs are structured that way. But many also, it's either forgivable, meaning that after a certain amount of time, you don't have to pay that loan back, or repayable either in monthly installments or at the time of sale. And then an FHA, this is another one that we see a lot for self-employed, because it's looser on credit and debt to income. So like I said, if someone has, business assets on their credit and they are paying that personally, I've seen it. It's like it's more common than I think. And I'm sure, Chris, you probably see that as well. What I would recommend, not as a tax professional, but as someone who's in the mortgage world, if you have assets from your business tied to your personal credit, make sure that your business is paying for those assets out of business accounts. Chris, is that accurate to say?
Yeah, you got it, Jared.
Yeah, cool. So these are the biggest things. Does anyone have any questions on any of the programs, anything specific to qualifying for as a self-employed borrower, any questions you've heard. All right, so here's the biggest takeaways from qualifying, getting in the mortgage space. So don't necessarily need 2 years of self-employment or 24 months, only need 2 years of self-employed returns. Like I said, that is a big misconception in the self-employed space. There are loan programs specific for self-employed borrowers to get them into these investments or these primary houses. Cash flow and appreciation are very, very powerful tools. Holding the asset is going to get you 3 to 7% on average. Obviously, it can go down, it can go up. For just owning the property, great tax savings, and overall real estate can be a wonderful tool to help build wealth. So, obviously, if there's any questions that you have, we'll send out this recording to everybody with a link to our calendars if anyone wants to get in touch with either of us. Both of us are on social media. Chris, where's the best place to reach you on social media or follow you if they want to get a hold of you?
Yeah, Twitter and or I guess X now, whatever they're calling it, and LinkedIn are the best ones. So it's just Chris Barrett CPA on LinkedIn, and then I think it's C Barrett _ CPA on X.
Cool. And for me, Instagram and Facebook are my bread and butters. I post daily on there. So thank you all for attending. Does anyone have any last questions for us before we hop off and get everybody back on their day? Patrick, Rich,
That was
Jason?
great stuff, guys. Seriously, super good. I mean, maybe you're already doing this stuff, but I would just say like there's so many like the investor Facebook groups and stuff that I'm in that I feel like people would jump all over this information. I know, I'm not as actively investing in real estate as I was 2 or 3 years ago, but this all would have been wildly helpful information. So, if you do have a recording, I would encourage you to toss it in.
Yeah, that's a good idea.
Thanks for that, Rich.
Yeah, I second that. Great presentation, lots of good information, especially from a bank side. Being able to share that with people, 9 times out of 10, people walk in and say, well, I talked to my brother, sister, cousin, and they told me to do this, or I went to LegalZoom and filled out a bunch of paperwork that may not protect them. So this is real good stuff, guys. I really appreciate it.
Awesome.
Cool.
This was really good information. I think you alluded to this earlier, where a lot of people have the misconception that if they switch from a sole prop and they just hear this big fancy word saying LLC, that this is like this magical thing that they're evading all kinds of tax issues. And I'm like, it doesn't work like that. So yeah, that was really good, and I think it would be a big eye opener for those people that they just think, hey, as soon as I open an LLC, I'm going to have all these huge tax savings. And, unfortunately, it just doesn't work like that.
Yeah, great point. I see that all the time.
Chris, I'm sure some of the stuff you see is, it's probably a learning experience day to day for you.
Yeah. You start to see it all after a while. At least it feels like it. But then the next one comes in the door, and you're like, what the heck?
Yeah. Awesome. Well, if there was one last piece of advice that you would give away for business owners, or someone to pass along to a business owner, what would that be?
Yeah, I mean, I think staying organized is very underrated, especially around real estate. And I see a lot of realtors have this problem of, not keeping everything organized, and then, taxes become more of an issue, and you miss out on planning and expenses and strategies. And so I think it's all starts from just being organized.
Yep. Awesome. Well, everybody, thank you so much for joining. Like I said, we'll get the recording out to everybody, but you guys have a good rest of your day. Like I said, go ahead, schedule a call with Chris. We'll send out the details to schedule a call, but please reach out if you guys have any questions for either of us.
Thanks, Jared. Appreciate it.
Yep. Have a good day, everybody.
Thanks, guys.